Hey there. Have you ever stopped to think about the pieces of paper in your wallet or the numbers on your screen and how they rule our world? Well, you've landed at the right place. Here on our channel, we unravel the complex world of finance, making it easy and interesting for you. Today, we're diving deep into the world of money, something so fundamental yet so misunderstood. We'll dissect its origins, its evolution, and how it continues to shape our lives every single day. So buckle up and join us on this fascinating journey. Let's start by answering a simple question: what is money? Money is any item or verifiable record that is generally accepted as payment for goods and services and repayment of debts. It serves three main functions: it's a medium of exchange, the unit of account, and a store of value. But money wasn't always the coins and paper bills we're familiar with today. Money has a history as rich and varied as humanity itself. In ancient times, there was barter. Barter was the direct exchange of goods and services. But as societies grew and transactions became more complex, the limitations of barter became apparent. The need for a medium of exchange led to the advent of money. But what form did this early money take? Let's dive into the fascinating history of money. Commodity money is an interesting first stop on our journey. This type of money has intrinsic value and is determined by the substance that composes it. It could be anything that's relatively scarce and durable. Cowrie shells, for instance, were used as a form of currency in different parts of the world for centuries. Precious metals eventually took center stage as the most popular form of commodity money. Gold and silver, in particular, became the standard because they're durable, divisible, and limited in supply. But using chunks of precious metals was cumbersome. How could you be sure of the purity and weight of the metal in each transaction? This question led to the minting of coins, standardized chunks of precious metals. The Lydian lion, minted by the Kingdom of Lydia in the 7th century BC, is often considered the first true coin. As societies became more complex, the need for a more practical form of money grew. This led to the creation of representative money. These were tokens or pieces of paper that represented a certain amount of a commodity, like gold or silver, kept safe in a bank. The value of these notes came from the promise that they could be exchanged for their equivalent in gold or silver. One of the most notable examples of representative money is the British pound. In the late 17th and early 18th centuries, Bank of England notes could be exchanged for gold. The promise on these notes stated, "I promise to pay the bearer on demand the sum of." The shift from carrying gold to carrying notes that represented gold was a major leap in the history of money. But what if the money wasn't backed by any physical commodity? This brings us to fiat money, which is what most modern money is today. Fiat money is government-issued currency that isn't backed by a physical commodity like gold or silver. Instead, the value of fiat money is derived from the relationship between supply and demand and the stability of the issuing government. The confidence people have in the currency and the government's ability to maintain a stable economy is key. The transition from representative to fiat money wasn't always smooth. The U.S., for instance, fully transitioned to fiat money in 1971 when President Nixon ended the gold standard. This move had profound effects on the global economy and marked the start of an era where governments had more control over their monetary policies. With fiat money, a new question arises: if there's no gold or silver backing the currency, what keeps it from becoming worthless? This brings us to the concept of inflation and deflation, key factors in the purchasing power of money. Inflation is when the general level of prices for goods and services is rising, and consequently, the purchasing power of currency is falling. Central banks attempt to limit inflation and avoid deflation to keep the economy running smoothly. Remember the Zimbabwean hyperinflation or the deflation during the Great Depression? Both situations caused extreme economic hardship, showing the importance of stability in the value of money. As we move towards the present, we enter the age of digital money. This began with simple electronic representations of money, like the balances in your bank account, which could be transferred using checks or credit cards. but technology has given rise to more sophisticated forms of digital money, including cryptocurrencies. Cryptocurrencies, like Bitcoin, are a type of digital or virtual money that uses cryptography for security. They are decentralized, operating on technology called blockchain, which is a distributed ledger enforced by a network of computers called nodes. As we look to the future, we see that the journey of money is far from over. The rise of cryptocurrencies, the possibility of central bank digital currencies, and the increasing shift towards a cashless society indicate that the nature of money will continue to evolve. Understanding the past and present of money is key to navigating its future. So, there you have it, a comprehensive dive into the basics of money. From its earliest forms as commodity money to the digital currencies of today, money continues to evolve alongside human civilization. Remember, financial literacy is power. It equips you to make informed decisions, secure your future, and contribute to a thriving economy. Don't forget to like, share, and subscribe to our channel for more insightful content, and leave your comments below. Thanks for watching, and until next time, keep investing in your financial knowledge.